Hello and welcome to a brand new show of Market Makers. Our guest on the show today is Tarun Kataria, Chief Executive Officer of Religare Capital Markets. Tarun, what a delight to have you back on the show. Thank you for joining us.
Good to be back. Thank you.
Let's talk about the market environment. Indian markets are up 20%. Looks like we are ignoring all the bad news.
I think there's a strong sense that sort of the reform agenda will come through, and I think that's driving the market like it did some months ago. There's a sense that interest rates will get cut first quarter calendar next year, which was exactly the scenario this time last year. So you're seeing the buoyancy in the markets, really on the back of sort of reform, at least the mood around reforms. Whether the reforms really translate into anything remains to be seen, but the messaging is right. You can see what's happening politically in Delhi. People are, at least the UPA government's pushing as hard as they can. 50 to 100 bip rate cuts are starting to be priced in, creating a good environment for the markets. And I think the other thing that people are sensing is that globally, from a macro perspective, we're probably at the bottom. Because even if you look at the China PMI data starting to say, okay, maybe the worst is over. So there's a lot of sort of good stuff happening globally and clearly driving our markets higher.
I like your analysis, but I think you're painting a too rosy picture. What if crude prices go haywire? What happens if something in Europe backfires? What happens if the fiscal cliff actually kicks in?
Well, you see, the event risk is always something to be mindful of. Personally, I think if you look at what they're saying out of the US, they'll probably sort the fiscal cliff out. If you look at this morning's press, sort of pre-Christmas, it's too intense a issue to deal with if it actually comes to pass. And if sort of the Republicans say, okay, there's some room to raise taxes, which I think is the right thing to do, and then the Democrats say, okay, there's we cut expenses and look at entitlements, which I think is the real sticky point. Because if you look at the U.S. budget, almost 70% of revenues go to entitlements, yes. Social Security, Medicare, Medicaid, and nobody's ever wanted to touch that because politically it's very, very sensitive. So there's a sense that there will be give on both sides. If there's give on both sides, cliff gets taken care of. Europe, I think, is long-term structural. And again, the noise coming out of Europe is, okay, Greece, we'll give Greece a little bit more time to sort itself out. I think longish term, France remains something to be very mindful of because it's, frankly, like India going down a socialist path. And we all know socialism doesn't necessarily do much for people's GDP. It's great to talk about, but does nothing for GDP. So that's a concern.
True capitalist speaking.
It's not true. I mean, you've got to find the balance, but you can't go so far left as we saw in our own country in the 60s and 70s. It did nothing for GDP growth. So we need to be mindful of that. So I don't think there's anything major event risks that can come out of Europe. Fiscal, as I say, will get sorted. Europe, everybody's pretty much priced in everything else. The overhang 6 or 8 months ago was China, hard landing, soft landing. I think that's now gone away. And the sense clearly is China's bottomed. Service PMI was 53, 54. It's sort of stagnating there. But manufacturing has now gone from, a 4 handle to just above 50. So people are feeling a little bit better about that.
Tarun, a very basic plank on which Indian markets have rallied this year is global liquidity. Yeah. If you are making a case that the global growth is making a comeback, the repercussions could be that central banks, they could take it easy, and that could challenge global liquidity, which indirectly would impact us.
I think that's a long ways away. I don't think, whatever you might do, even if the US comes back, it's going to come back in a very muted sense. Because I think one of the things that we don't really talk about enough is the demographics of the US, like the demographics of Europe, almost suggest that you can't go back to 3 or 4% GDP growth because the baby boomers have passed. The productive population of most of the westernized economies is declining. So you cannot go back to the growth rates that we saw over the last 20 years because the productive population just doesn't exist. So if you get to a run rate of about 1% GDP in the US, I can't see it getting much beyond that. And that suggests that you cannot aggressively raise rates to spoil the whole global liquidity story. So I would suggest the global liquidity story continues. Maybe in a couple of years, people start talking about, long bonds sort of going from, I guess, 160 or 165, whatever it is, to 3%, just to throw a number out. But plenty of time for that.
Now, what has differentiated Indian markets from rest of the world is the entire consumer story. So what's the best way to bet on Indian consumer?
I think there are three ways to play it. Obviously, there's a discretionary way to play it, which we think right now is something to be thinking about. Financial services is a way to play it. There are a number of sort of NBFCs that sort of service that sector. Banks generally, I think, are a great way to play it. And obviously, the FMCG space, which expensive at the moment, but still a long-term, there'll be many more consumers coming out into the spending sort of story. Those would be the ways to play it. Real estate, obviously something to think about from time to time.
Is it too early to take a dive in deep, in beaten down cyclicals?
I think it's a bit early. We've seen some of these names sort of rally, but are you going to see 50, 60, 70, or doubling in a couple of years? It's probably still a little bit too early in my view.
Broadly, if I map the percentage change this year, Indian markets are up 20%. Do you expect a double-digit gain for next year as well?
See, if you believe global GDP or global macro is at its flow and starts to pick up, if you believe liquidity continues to be as I do, if you really believe that India slows down sufficiently and CPI comes off, WPI comes off, and the Fed or the RBI is able to cut rates by, I'm getting aggressive here, but let's just say 200 basis points, that sets the basis for, can we go to 23, 24 on the Sensex by the end of next calendar? Sure, you can. Absolutely can.
The consensus on the street is that Reserve Bank of India come Jan 2013 will cut rates and that will kickstart a new bull market. Isn't that too naive?
I think that's my personal view. I think that's a bit optimistic.
That's a consensus view. But
it is a consensus view, which is what happens. So consensus drives the market, as we've seen driving the market higher. But when they actually figure out, or when we all figure out that actually 50 or 100 basis point cut is not moving the needle, you need 300 or 400 basis point cuts in rates, which cannot happen given where we are with our inflationary numbers. The market will sort of pull back a little bit, probably for a short period of time. So I'm not of the view that there's going to be, material cuts in rate that drives markets massively higher from here. Inflation is structural. That's the problem. And it's been there despite growth having come up from close to 10% to what this year, this fiscal, if we're just above 5%, would be a good outcome. So I don't see massive cuts by the RBI.
What drives the market are three factors. Number one is sentiment, which has improved. At least global sentiment towards India has improved. Yep. Second is liquidity. We made a case that there is a lot of global liquidity sloshing around and hopefully India will get more liquidity going forward. The third important trigger is earnings, which is the most difficult one to predict.
Correct.
What are your thoughts there?
Well, I think that's a tough one. Are we going to see a massive material pickup in earnings just yet? I don't think so. We were also to think commodity prices come off, rupee goes to 52, 53, all that sort of it's on its head, and GDP growth will remain muted. So I don't see a material change in earnings, and therefore you sort of got to question whether companies trading at 30, 35 times, while are perfectly good companies, whether it's time to sort of take a little bit of money off the table. So are you going to see material changes in earnings from here over the next 12, 18 months? Probably not. But are we at the low point? Yeah, we're pretty close.
This time around, if I look at brokerage recommendations, for the first time, we've got more upgrades than downgrades. Do you think earnings, if not in Q2, maybe in Q3 will bottom out for sure?
As I say, we're 1 or 2 quarters from the bottom. But it's a parallel to the US GDP story. Are you going to see a huge jump up from here? The answer is no, because the rupee is going to continue to remain under pressure. Growth will be subdued. Commodity prices, if China starts to recover, and there's every reason to suggest that the recovery of China is underway, that will put upward pressure on commodity prices, which by and large is not good for us. And if the fisc remains under pressure, which I believe it will, I think the numbers will be close to 6%, maybe tad higher than 6. It's going to put pressure on the currency.
Can we make a case for a bull market if rupee remains under pressure and fisc is high? Because these are two factors which always sort of restrict the upside for any equity market?
I think it will. As I say, we're not going to see runaway, this 3-4 year bull market story. I'm not personally convinced just yet because for precisely the reasons. What's driving it is liquidity. Liquidity stays, but the fiscal will be under pressure, rupee will be under pressure. But see, again, rupee is an interesting story. If the FIs decide, as I'm sure they will in January and February, when they've got fresh allocation of money to put in the emerging markets, as we did this year, you will see a gush of money into India. Rupee, in Q1 calendar next year will probably be better than it is today. But it'll be an early front-end loaded move in the market.
Do you think it's the overall pessimism which could fuel Indian markets? If I look at what domestic institutional investors have done so far for this year, they've got net outflows. They were net sellers to the tune of about 40,000 crore, which means that the average Indian investor is still shying away from Indian equities and is still investing in gold and real estate.
And, people have got burnt in equities at least a couple of times over the last half a dozen years or so. So memories can be slightly long.
Especially when you lose money.
Especially when you lose money. But I think like everything else, once people tend to jump on a sort of bull market bandwagon. And if you see that, I think, many of them come back. But I think there's been a lot of pressure on the mutual fund industry. There's been a lot of pressure on the insurance industry. So that whole garnering of deposits that drive markets for the domestics to be net buyers really hasn't been there, because if you look at AUMs of all the DIIs, they've been flat. And if they're not flat, it's because the markets are up generally. So there's no new cash coming in. So you've got to find a way to encourage investors to put in a larger part of their saving portfolio into equities and frankly away from real estate and gold.
So let me rephrase or phrase my question rather carefully here. For a first-time buyer who is convinced and encouraged after this show that he wants to, take a bet in Indian equities, what should that first-timer buy? Bet on expensive consumer names or buy cyclicals now, where there is a strong scope of recovery?
See, I'm an old school guy, right? There's no way you can convince me that an individual investor with X amount of rupees, first-time buyer says, okay, maybe he's in his mid-20s and he's got his first job. There's no way people should be buying individual equities. You've got to be buying funds, because the fund manager community is an experienced community. That's all they do.
They've not made money in the last 4 years.
If they haven't made money, where's an individual investor going to make money? He might make money on one or two stocks, but on balance, I don't believe it's proved.
You have some lovely recommendations.
You have some great recommendations, but you've got to have diversity, because investing is about diversification and it's about compounding. If you forget those two, you actually can't make money. So you've got diversification in a fund, or if you want to do it individually, I can give you 20 names that you can buy and hold for the next 20 years and you do phenomenally well. But to put your money in 2 or 3 stocks and say, okay, this is the way I'm going to go, not the best idea in the world. So you've got to have diversification and you've got to let it compound. So the mentality of in and out every day, it's great for me, but that's not the way to build a portfolio.
There's an old maxim on Wall Street, which is that in markets, courses remain the same, and horses, they change. So which are the new horses you're betting on?
Gosh, I would sort of start with sectors. Obviously, we were talking about a little while ago, media with all the digitization seems to be a place to be. We're still constructive on sort of financial services, banks.
But early days for media.
Early days for media. I think banks, we generally remain constructive on. Sectors that we're probably less interested in continue to be real estate, infra, consumer discretionary we like. So it's, we like an M&M, which has a sort of good governance story around it, names like that. So you can get, 15 or 20 names that you can buy and hold for the next X number of years and actually do quite well. And there are many, many actually small NBFCs that have got a very good story going. And those are the ones to look at as well.
You've used the word NBFC thrice already. What makes you so hot on NBFCs?
I think the overhang, one, it's an industry that's required in this country. The banking system, frankly, is not big enough to support it. If you've got the right sort of infrastructure, architecture in place, the need for them is very, very high. I think the regulatory overhang, the worst of it at least, is behind us. all of them have spent the last 12, 18 months really putting a good credit system, IT, technology in place, and will continue to grow at least 3 times of GDP, which if you assume is 6 or 7%, you're growing at 20% a year. It's not a bad place to be.
That's Tarun Kataria, the investor speaking, or that's Tarun Kataria, the CEO of Religare Capital Markets speaking?
Bit of both.
So when do you think Indian markets will snap out of this range, this 4-year range?
Tough to say. If you look at China, China's been in this range for 5 years, and China is an economy 4 or 5 times as big as ours. I would have thought, listen, if liquidity continues to remain high, if you believe earnings are pretty close to their bottom, if not this quarter, certainly the next quarter, the global situation, and I believe it does look a little bit better, I think you can make a case for a nice move up. Now, you've got to separate the markets from the macro, and we can have a separate discussion on that. But I think the markets probably in 2013 do better.
But are markets running ahead of the time?
As they always do, right? I mean, that's what markets are. The pendulum swings excessive both ways. Market's probably fairly value to these levels, and if you get, as you correctly said, if the upgrades start, and if you believe there's a 15-20% change in earnings over the next 12 months, good time to be looking at it.